It is Monday, and we're talking about your money today, so we're going to call it a Money Monday. The markets have been in the news a lot lately because of the war with Iran.
Joining us today with a couple of quick tips about the stock market is John Schwalbach with Freedom Financial Partners. John, it's nice to have you on the show.
Yeah, thanks for having me.
For folks who follow the markets, they probably noticed the Dow closed down almost 800 points on Friday. Good news is we're starting to see some green arrows, and I just checked, the Dow is up almost 400 this morning.
There we go.
So let's talk about the stock market and kind of what's going on with everything in the world today, and give me just kind of your 2000 level look at the markets right now.
Yeah, so I think when people come and talk to us about the markets for the first time, oftentimes they equate the markets with risk, right? Because it can feel risky.
Yeah.
Things move up and down a lot, but we try and reframe that for our clients and talk about, when you buy into the market, what are you really owning? And you're really owning shares of great businesses, right, that are designed to grow and increase profits and, really, be a place where we can look more long-term than short-term. And so Warren Buffett said that his favorite holding period was forever. And I think if we started to look at markets more in terms of years and decades instead of just days and weeks, we'd be a little bit better off.
Oh, I mean, they definitely say to not look at your statements. Don't, try to ignore some of these ups and downs. That can be hard, though.
Yes.
People think about the risk of their money.
Yes. So when we look at market risk, I think the longer, we can look, the better off. So we talk to our clients a lot about looking at risk in terms of decades. So if we go back to 1980, okay, and just look at the S&P 500, which is a pretty good measure of the U.S. market. It's been up 35 out of 46 years, right? So 3 out of every 4 years. But in any given year, it can be down somewhere around 10 or 20%, on average about 14%. And that's what we've experienced so far this year. So what we're seeing is actually pretty normal. And for people that want to be good long-term investors, oftentimes these can be good buying opportunities.
So the Dow just hit 50,000 last month. It's now down to like 45,000 something. I think that kind of drop makes people panic a little bit, right?
Yep.
What do people do? What should people be doing right now when the market goes down like this? I mean, is it mostly, are you a counselor to people that say hang tight? I hear you, I feel you.
Yeah.
What do they do?
I love to buy things on sale. I think people should look at the stock market in much the same way. Oh. When markets go down, these are temporary, long-term buying opportunities because the market's always reached higher highs. And so think of it, when we see downturns, these are opportunities to go buy some of the best-run businesses in the world on sale, okay? The most extreme, I guess, period that I've seen in my career took place in 2020 with COVID. Mm-hmm. So if you think of when COVID hit, in 1 month, the S&P 500 dropped 34%. That's very scary and pretty unsettling for most of us. But before the end of 2020, it recovered 50% and actually ended up 16%. So the best long-term buying opportunity was actually when the market was probably the scariest for people. And I think that's how we have to start looking at investing, is when the market's down, it's a good buying opportunity.
So when people look and they see in the news and the market's down 800 points like it was on Friday, should that be when they pick up the phone and get in touch with somebody like you? Like, I want to get in right now.
Yeah, I mean, what we would tell people is, first of all, usually when markets go down, this is not a good time to panic and sell, right? Oftentimes you want to stay the course, you want to stay in your seat. If you have excess money to invest, it can be a good time. We don't know if the market's going to go down more from here or not. We can't predict that. We're not in the prediction business. But this tends to be a better opportunity than even a few weeks ago when the market was much higher, because we feel like we're buying great companies on sale.
Mm-hmm.
Talk about world events and how they impact the markets.
Yeah. There's a chart that we use with our clients, and I think what's really great about looking at market history is just that this is a chart going back to 1970. If you look at putting $10,000 in the S&P 500 by the end of 2025, so again, 56 years of market data, by doing nothing, just letting the market compound, it grew to over $3.5 million.
$10,000 grew to $3.5
Correct.
million.
That's the power of compound interest. Albert Einstein called that the eighth wonder of the world for a reason, right? So I think that's really important to invest through all market cycles, but also during geopolitical events like we're seeing today, wars, recessions, global pandemics. The market tends to go higher over long periods of time, but we just have to let it work.
This is good insight. Appreciate your time. Before we go, is there some final advice that you may have for people?
Time in the markets is more important than trying to time the market. So again, if you go back to 1980, 10,000 invested in the S&P, by the end of 2025 would be over $2 million, but you have to be in the market the whole time. There's over 11,000 trading days during that time. If you miss just the 10 best trading days, you don't have 2 million, you have 873,000.
Wow.
Because after some of the worst trading days, we see some of the best trading days.
Let me ask you real quick before we let you go. I keep referencing the Dow. You keep referencing the S&P 500. Am I looking at the wrong number? Should I be looking at the S&P 500 and not as much the Dow? I think the Dow is the bigger number, and that's what fluctuates, and that's when you get the big 800.
Right.
The S&P is a much smaller number, so you're looking at percentages.
Yeah, so I think they're both good to look at. The S&P is 500 companies, and it starts with the largest and it goes down to the smallest of those 500. So it's a broader measure of the U.S. market versus the Dow, which is just as fewer stocks. The Dow's been around for a while, but I think more people tend to reference the S&P today just because of the makeup of how many companies are actually in the S&P. It's the vast majority of the U.S. market.
All right, good to know.
John, thank you.
Yeah, thank you guys for having me.
Thanks for coming by. If you'd like to work with John or learn more about Freedom Financial Partners, head to minnesotalive.com. Put a link to their website right there.
Coming up.